We have a question. Someone says, please talk about the Fed reducing its security holdings. And how does the Fed reduce its holdings?
Okay. Going back to what I've explained before, the Fed and the Treasury, two separate things, right? Mm-hmm. Treasury issues Treasury securities, Treasury bills, T-notes, whatever. The Fed is controlling monetary policy, or is the one that manages monetary policy, right? So when the US Treasury issues Treasury securities into the open market for sale, the Fed actually comes in as one of its tools to manage monetary policy, buys or sells its treasuries in the open market. So just think of it this way. The Fed buys Treasury securities from the open market. What happens when you buy something from someone, right? You take the thing and you pay them in cash. That actually is easing. That's putting money in the economy if they buy the treasuries, right? Mm-hmm. So for this question, the Fed has a portfolio of treasuries. They do. And that's a tool that they use as part of their monetary policy initiative, controlling the money supply, right? So if they keep buying a lot of treasuries, it's called QEs, quantitative easing, because when you buy a lot of things, what are you doing? You're just paying for it. And all that money goes into the economy, right? Mm-hmm. Now, quantitative tightening is when they let their treasuries roll off. Treasury securities mature. And if you don't replace it, just say, for example, the Fed has, I don't know, $1 trillion or, whatever, a certain amount of treasuries in its books. Mm-hmm. As the treasuries mature, if it keeps buying it, guess what? It keeps injecting money in the economy. But as the treasuries mature, its holdings go lower as they mature, it doesn't buy it back. Mm-hmm. Guess what? It's tightening, right? It's just letting it roll off, and they're not going out in the market and buying anything. They're not injecting money in the economy, right? And right now, the Fed has been doing quantitative tightening for the longest time. They were allowing, like, I think 60 billion of treasuries, I think on a monthly or quarterly basis, mature without replacing it. So now they're going to start easing. They're going to start buying back like 25 billion or 40 billion or something like that. So that's how the Fed, buys, manages its balance sheet.
Tightening.
Yeah. If tightening is when you don't replace it. You don't go buy anything, so you don't put money back in the economy. That's tightening.
I see.
Right? Oh, it's when you sell. They're selling your treasuries, money is coming in. That's tightening. Easing is when you keep buying the treasuries and pumping money mm-hmm. out into the economy. Mm-hmm. So just remember, the Fed has a portfolio of securities. This is a secondary tool it uses to manage monetary policy on top of interest rates.
Got it.